Okay, last year at the VC panel in ET Soonicorns Summit, Ritesh would remember, we discussed startup reset. But this year it's about surge. So from reset to resurgence, we have traveled a long way in the past 1 year. So we see that, so in the last couple of months, 3 new unicorns have come up. The $100 million deals are back. So I would start with you, Ritesh. So what has changed beyond the headline numbers? What's happening? What has really changed and what is driving that change?
Thank you, Manu. Hi, everyone. I actually remember the conversation that Manu and I had, and at least the framework I operate from is to not get too depressed in times when not much is happening, and not get too excited in times when too much is happening. Today seems like a very happy balance. I think what has happened is 2 or 3 things. Most of all, I think the animal spirits are back a little bit in entrepreneurs. And the reasons for that, I think, are 2 or 3. One, there has been quite a bit of liquidity because of the recent IPOs, and I don't just mean in the last year, but in the last 3 years or so. And that has shown future entrepreneurs what is possible. Of course, it has also created some wealth for the people working in those companies who are now feeling financially secure enough to go and start their own companies. But it's actually the example that matters a little more than the wealth. The second thing that has happened is, I think entrepreneurs have realized that the sky isn't falling. We had, I would say, 18 to 24 months of time when entrepreneurs were frozen more than the funds were. Late stage rounds are still not fully back, but entrepreneurs are realizing that early stage funding is available, and if they have a good idea, all of us are ready to fund them. So the risk aversion that we had seen between, I would say, the middle of 2022 and end of 2023, I think that has reduced quite a bit. And third, I think there is a rub-off effect of the broader economy on the startup ecosystem. The fact that the stock markets are doing well, the fact that inflation is in control, the Indian economy hasn't tanked in any way, as many people were fearing. I think that has a rub-off on on people wanting to start new companies as well. So I do think that this is a very nice, happy medium place to be in, where we are not yet, and hopefully will not get to a point where there is overfunding and overexcitement, but we are also not in a frozen place anymore.
Okay. Prayank, last year, 2023, at nearly 10 billion, the VC funding was at the 7-year low. But in the past 6 months, it has picked up. The numbers show it's about 26% up at 6.6 billion year on year. So, and of course, so everybody is seeing some good tidings. Accel has just added 1 unicorn. Moneyview has just turned unicorn, and large fundings are back. So, what's really happening? So, in your point of view.
So, see, I've been with Accel for now 13 years. The year I joined Accel, the VC funding in India was $600 million. Okay, so it's actually not 26% year on year. I see it's like a CAGR, and I think India is in a very good place where it'll keep on growing, right? So I think what's really happening is what Ritesh also alluded to. There is a lot of confidence in the Indian economy. And we were discussing this outside, that the consumption power of Indian economy is, India I think is like a 50% consumption economy or more, and the consumption power of consumers the consumption power of businesses, all of that is going up. It's all in a great direction. So if you take a decadal view, you believe that large profitable businesses can be built from India. A lot of our investors come and ask us that, do you think India will be able to support, 50, $100 billion companies, the public markets? And my answer to them is, I don't know that, but I can tell you that India will definitely have 50, $25 billion companies in the next decade or so. That's definitely going to happen. We already have examples of a couple of companies in private markets and public markets are there, which are profitable. And I think that lends a lot of confidence to us as investors, and more so to entrepreneurs. They see this, entrepreneurs read opportunities much better than much better than VCs. They are seeing these opportunities right now. We are seeing a resurgence of deep tech. We're seeing, not resurgence, emergence of deep tech. We're seeing emergence of consumer brands. So many sectors which are available as opportunities for the founders to take advantage of. And I think that is what is really leading. It's a leading indicator to what is to come. It's very hard to imagine the future, and I'm really, really bad at that. 20 years ago, like 2004, I graduated from college. At that time, I had no idea what VC was, how to do a startup, can you go list. But today, a founder who starts off in first year of college, he has all these examples of a journey. What can I do in second year of college to become a founder? And there's enough knowledge out there, tribal knowledge, that this is a chosen path. So I think that is what is really the green shoots or raw material available for yielding a very thriving startup economy for India. So that's, I think, and why that changed in the last 2 years. I think public markets have a very big role to play. All VCs were on the sidelines. We were always like, if you see most of the VCs build their companies to be US domiciled, assuming that money will come from US, assuming that only those companies will get funded. But I think that has dramatically changed. Domestic capital has come into markets. So a lot of things have changed, and it's our moment to shine, essentially.
Yeah, like Prayank and Ritesh had said, the public market is more upbeat than probably VCs at the moment. So, and we also see that there are a lot of action in the startups and also probably in VC funds too. So Amit, you have just added one partner. I remember, 9 years back, when you were coming on as the partner, and now, so what are the actions that you see right now?
Yeah, so I think like both Ritesh and Prayank said, I think India's moment to shine is now. One of the things that is very important to us at Prime has always been, we're all sort of operators turned VC. And so we just added Bridge to our team. He was the co-founder at Magic Pin and had sort of been building that for 10 years. So it was interesting to hear Hari talk about quick commerce and so many things that Bridge is talking to us about now. So I also think that the entrepreneurial talent is also now increasingly thinking about potentially having VC as one option. And also the set of companies that entrepreneurs are doing now, whether it's the second, we were again talking in the hallway, second time or third time, younger founders doing companies, that's another sort of interesting trend. So definitely, I think the quality of the talent has also improved a lot, both on the entrepreneurial side as well as the VC side. And I don't think we can underestimate this notion of the IPOs. So actually, VCs are super excited about the IPOs, not necessarily just the valuations, because exits was this one sort of bad kind of 4-letter word for when you're going fundraising, saying India will always consume any amount of money in venture capital, but when will money ever come out on a sustainable basis? So the fact now that companies can go IPO, I saw that Traction is listed as a research partner for this summit, I think is very interesting. Even at a modest scale, companies can go IPO on the main board or the SME board. And there are so many that are lined up. Now, of course, they'll have ups and downs. But exits is something that has become a lot more prominent in the mindsets of VC, certainly, right? So when we are going in fundraising, you can't just say we're fundraising, India's great, it's a consumption economy. It's like, when am I going to get the money back? So I think those are a couple of things I would say: improved quality of talent, and then a lot more focus on viable exits.
Yeah. So exits excite. That's what's happening here. Yeah. So Kanika, so I saw a recent media interaction where you said Vertex is also, expanding, increasing, the activity. So could you just give more insight into that? Yeah.
Sure. So we are now in our fifth fund, and so the context to that comment was that within funds 1 to 4, India was maybe 20% or 30% of the allocation. But now that we're deploying a larger fifth fund, we can clearly see more excitement and curiosity about India, right from our investors, LPs, to our IC, and that ties in very well with the depth and the width of opportunities we are seeing in the market. So I think for a global fund, a couple of things have changed, right? I think the first thing is that the India ecosystem has matured to a point where you have the first wave of successful startups, and these are becoming more visible globally. So of course you have the first 10-year VC to IPO cycle, which has been completed. But at the same time, you have a lot of startups who've actually expanded successfully into the US, for example. They're setting up US teams, they're hiring US people. So I think globally, people are seeing the potential of Indian startups, and they're becoming more comfortable with the fact that these companies will, in the next 5 years, scale and compete globally. So I think that's a very sort of visible shift which is happening. I think the second thing is happening is that there's been a lot of migration back from the big tech in the US back to India. People are looking to start up, and that also ties in with a very mature founder ecosystem. There are graduates who are a lot more ambitious today, and also people who've worked in tech are now leaving to start their own businesses. So we're generally seeing, I think, better quality of founding teams. And this is getting our IC very excited. And I think the third thing is that if you're a fund and you have to deploy hundreds of millions of dollars, India is one of those markets you have to consider. There's going to be a lot more global capital flowing into emerging markets, and within emerging markets, India has a lot more depth and capacity to absorb this capital. So naturally, even from that perspective, when you think about the next 10 years, the region is just becoming more important for us.
Yeah. Okay. Hi. So Anand, so Zepto raised a large round, and Rapido. So you added one unicorn now. So what has changed?
From when?
From say last 2022 or 2023.
Why I asked about what from when is because it's not unusual for VC ecosystem to have the cycles. Absolutely. VCs, this ecosystem has always, whether it being 2016, whether it was in 2007, the mother of all cycle was 2001 when all the webs, obviously the Indian startup ecosystem is much more new.
Wasn't this unusually longer, if I may ask?
No, it was actually what has surprised me this time around is that the cycle was much shorter. And there were multiple reasons because the cycle more than, and I know that the entrepreneur side probably all of the panelists touched upon. The other side was that there was a major shock on the capital, on the private markets, which was happening in the US. There was another macro which was playing out that China suddenly became uninvestable. So while there was a shock which stopped a lot of private side capital flow, which also thawed a lot of exuberance. In between, there was another wave of exuberance around Web3 and all, where a lot of capital went, which never came back. So this was, suddenly there was a big thaw where people were like, should we be investing now or not? Why should we be investing in private markets when public markets? And the entire VC or the private market ecosystem almost works like an assembly line. There are seed stage investors, there are Series A investors, there are Series B investors, and your startup has to graduate from one cycle to another, otherwise it just gets stuck because it needs capital to grow into that. Now that thaw has happened early in Series, I would say before Series A sort of a area right now, because as Kanika touched upon, a lot of the capital deployment that can still happen on the private markets, and a lot of us early stage funds, we had raised money also. So that action is happening. In between, there was a pause from the founders because they were also scared to go in that market, that whether we venture in this market, how much capital can we raise, at what valuation do we raise. That has also unlocked for the various factors which, let's say, Ritesh or Prayank touched upon. However, while there is a lot of action that is happening either in this stage or in the late stage because the IPO and the public market, the multiples that Amit touched upon, there is still a lot of concern, if I say, still remains in the Series B, C step. So there are nuances to what is happening right now in the market. We will, in the long term, these all things don't matter. In the long terms, what is happening is that India is probably one of the only very scaled ecosystem, which is growing at a very, economy which is growing at a very fast pace. It is an economy which is unusually digital first. If you think about it, in 2010, we were talking about whether there will be e-commerce in India because there weren't enough credit cards. There was no payment system. And look at where we have reached with UPI and all the things that's happening. So it's probably the one and the only unique, very large-scale ecosystem which is growing at a very fast pace and is digital first. So if you build for a company, these cycles will probably not matter. However, the way the capital is going to, the way the overall macro in the world is working, India will remain in a unique space where a lot of capital will attract this ecosystem.
Okay, we discussed about resurgence, but I think still, it's worth looking at the learnings from the past 2022 and 2023 from the reset. Every year, we do this annual exercise at ET Prime. We look at the unicorn financials. So when we look at the 100 plus unicorns in the country, so we saw that nearly 40, have turned profitable or on track to profits, in a very strong position. And when we look at their, combined revenue, it has gone up by about 35%, while the combined losses of all unicorns put together has come down by about 25%. So this question is to everyone, so starting from Prayank. So it's, so has the startups by and large become a lot healthier during the reset phase of the last 2 years?
Yeah, I think everybody got schooled by the downturn in the market that there is no free money available. So you have to become profitable. And, I think it's very difficult for a founder to say no to easy money. And once you get easy money, it's, you will spend it. So bad habits set in. But once the money was not available, people have to learn how to operate efficiently. And I think that is one. Two is a lot of the public market companies which went, they were still in that phase of spending a lot of money, and the public markets in India punished them, and they learned the lessons and they became profitable. So that automatically, if I am on the board and I am telling a company, the founder might or might not agree. But when the public market is telling the founder, he has to agree. So I think that is a second lesson, I think that combo made the founder mind shift easier towards, it's a very hard job to do because you still have to figure out how to keep on growing. So that came in the third acceptance by a lot of investors that it's okay not to grow at 100% or 200% year on year. It's okay to grow at 50%, 40% and become profitable, right? So I think that these trioca of things has led to this healthier balance sheet, healthier capitals, healthier P&L statements. And I think that will continue for some time because I think it's just a nice way of building a company. Of course, if now the Fed has cut the rate, what happens if suddenly market again resurges and like Kanika was mentioning, in India is the talk of the town today to get money. I'm sure we are at 10 billion or whatever that number is today. In 2021, we are 40 billion. There will be a year where 100 billion will be deployed in India in the next decade. And things will shake up again at that time. But today, that is the trend. So,
Amit.
Yeah, I think we're at a good kind of healthy medium of sort of growth, but not at all costs, right? At some sort of, so in SaaS companies, in B2B SaaS, there's this, used to be this kind of, rule of 40, which said your growth rate plus your, profitability should exceed 40%, right? So if you're growing very fast, but you're break even, that's okay. Or you're loss making, then that'll add up to that rule of 40, right? So I think people are doing it in a lot more balanced way. I think there was some slowdown in funding. So I think competitive intensity went down. I think marketing spends went down. I think, randomly going and opening 4 flanks kind of went down. So I think we're at a more healthy medium. And I think it's also more sustainable. So now even earlier stage founders will start quoting public market metrics like, oh, we could get this multiple of EBITDA or that multiple of PAT or this multiple of, as used to be, this maybe 3 years ago or 5 years ago was multiples of GMV. So I think it's just better for the long haul, in my opinion. I think it can overcorrect from time to time when there are, people like us asking for, EBITDA or PRAT, break even at Series A, which is really not the, reason for risk capital from venture capital. But I do think overall we are at a healthier balance now than perhaps we were earlier, which was growing at all costs.
Yeah. So, see, the question of profitability is way more nuanced. It cannot be, I actually will not, there will be multiple of my portfolio company whom I will not encourage right now to turn profitable. It changes from the stage of, as many entrepreneurs would be sitting here, it changes from the stages of the company. At like seed, pre-series A, you are running micro experiments to see if this thing works or not. You try to get to a PMF, you will be burning money on multiple things. You will grow to create the first set of customer whom you will harvest for later. It changes from the type of companies you are. Consumer company, you have to harvest the company and work on the LTV. If you are a SaaS company, there is no reason that you are not profitable. If you are an enterprise SaaS company, it's very different. So it's very contextual whether you are profitable or not. Now, what is happening overall is you are seeing probably a lot of the first cohorts of the startups in India maturing. So there are first cohorts, if you put it like the Zomatos of the world or the Flipkarts of the world, they are in public market, they are maturing. The second waves, where you are seeing the large unicorns, they have to turn profitable somewhere and show that the business model works. That is very heartening to see. So at that stage, multiple of the companies which are over there, they should be encouraged to now you show that the business model also works and there is a money that is going to come back. But there will be, and the other thing that is happening is that actually the Indian ecosystem and the consumer is also maturing. What Hari was talking earlier, that they are ready to pay for digital platforms. You would not imagine even people paying 230 to 300 rupees on subscription for content like a Hotstar. That's also happening. So there are things which are changing where things will move towards profitability, but it absolutely makes me happy, which proves that the Indian ecosystem and the consumer is ready to pay for the digital ecosystem. But at the same time, I wouldn't straitjacket it into overall all the startup and start being happy because the companies, let's say, started becoming profitable. That will not fit the VC model that we go for. That might fit for some other model of capital, but that's not for the VC model.
Got it. So, Kanika.
Yeah, so I think the view will be unanimous, right? That it's great that the companies are becoming more conscious about capital. So I think the way we want to index is on capital efficiency, which is maybe a little bit more nuanced than saying, oh, how fast can the company turn profitable? Because I think like what a lot of people were saying, the metrics of investment are changing at every stage. I think perhaps what had happened in 2021-22 was that growth was being rewarded with a huge premium. And even for us, we also expected that the growth premium will continue going forward at the Series C, D, E levels. I think what the public markets have shown us that at some point, the premium moves towards profitability. But that point also cannot come too soon because the VC model indexes on large scale, right? So I think for earlier stage companies, the question is still on product market fit and scale, but having a little bit more mature conversations on what the business can look like in the future. And I think for a little bit later stage companies, it is prudent for founders to start thinking about capital efficiency, which is very simplistically, if you've spent X amount of dollars, what has that gotten the company to in terms of top line? And then, that can be nuanced further in terms of the business model. So I would be too cautious to jump into profitability as a new buzzword. Most likely the buzzword will change next year. But, this focus on capital efficiency is actually great for the ecosystem.
Ritesh, what's your take?
I love how, as we're moving from the right side to the left as we are sitting, the cynicism is increasing. So I will offer the most cynical view on profitability. Okay. I'm actually very concerned that the narrative has shifted from growth to profitability, because you can have let's say you start a pawn shop tomorrow. It's profitable from day one. That doesn't make it a great business. So the objective with which all of us fund businesses is not that it should be a profitable business. We fund businesses that become profitable at scale. And so I'm actually very concerned. On the drive here, I was having a call with a portfolio founder of mine. This is a Series A funded company. And the founder was talking about all the barriers to profitability in his business. And I found myself in a weird situation where I'm the one telling him to not worry about profitability today, and the founder is saying, I cannot run this business because I don't see it becoming profitable in the next 12 months. So I'm actually quite worried that the trend is dangerous. And it is dangerous because, again, I'll offer a slightly cynical view. I don't think it is because of a buzzword or because suddenly we have all discovered that businesses must be profitable. All of us are smart enough to know that businesses have to be profitable. That's why we are all investing. That's why the public markets invest. But it is because of the lack of capital at certain stages. So when the unicorns figured out that there were no $200 million rounds happening, that's what forced them to look at profitability, and it did not come without its cost. When a unicorn wants to become profitable in the next 12 months, it has to sacrifice future growth. And that's probably fine because we realized that the scale that we were aiming for was not probably a $20 billion valuation, but a $2 billion valuation, and so it made sense for them to turn profitable. My concern is when a Series B company realizes that there are no $25 million rounds to be had, and that the only choice is to become profitable, that hurts all of us in the, not even in the distant future, but in the near future. Because before they are able to prove that the business actually works, which is, does the customer want the product, does the business scale, does the business deliver unit level profitability, and then does the business deliver company level profitability. And there is no way to short circuit this. If you try to short circuit it without proving that there is a large enough opportunity, if you try to become profitable, you will unfortunately end up as a pawn shop business. So I'm a little concerned at this trend, and I don't want to necessarily celebrate the fact that every startup is trying to be profitable very early. I think it's a little dangerous.
Can I add one more thing to this? This actually is having, and I'm a new observant to that, I used to be more on the operator and the entrepreneur side, is that even the VCs are becoming risk averse. This is a new trend, which is, I don't know how it will play out, because there are arguments to be made to both the side of it, that probably Indian GDP is going to grow at a particular pace, certain sectors will grow faster, certain winners will grow even faster. But the VC model, if you see the history of it, was to take outsized bet on dream shots in a way, or a power law to play out. But however, with this new thing on profitability, when you see there are multiple sectors or particular areas of investment which are coming out, whether that's best suited for VC model or not, and I can be a purist over there, has been a constant thing of discussion, at least within Nexus for us. That should we go and invest into something which is very well proven model, there is a new challenger coming, we know that the space is growing and things will come out over there, whether it be in financial services, whether it be in around the consumer retail brand and whatsoever. How do you take a call whether that's where the VC model is the best suited or not? And how will we behave at VCs when we have to answer to the LPs on the way the return profile has to be? And that conservatism, and because of this profit becoming the most important word on how it affects the ecosystem, is something which I'm probably observing to see whether it has a positive effect or a negative effect.
So VCs are becoming risk averse and public market is going VC mode.
That's not what VCs are supposed to be, risk averse.
Yeah. Okay. So now that so the resurgence that we start seeing. So every funding cycle, so some of the themes, start riding the wave basically. Now of course, AI, so Prayank, your statement, you've said that 27 AI startups you have invested in the past 2 years. So what's really happening? Which are the themes? Of course, AI is there, and AI plus, what else is happening now?
I think AI has definitely taken the imagination of founders as well as consumers everywhere, because it's just awesome. It's cool, right? And obviously today there's a lot of demand for that. And within AI, let me talk a little bit about AI, then I move to the sectors. But within AI, the way I think of AI is apps middleware or infrastructure, and then you have foundational layers, which is research oriented. In India, we are seeing a lot of the top two application layers is like almost every SaaS company or consumer company is now building something with AI or AI product. We are seeing a little less of the middleware, but we are seeing fundamentally very few handful of companies in the research layer, and that's what makes me a little worried. Researchers in India should come out and start building those companies. That trend is not there in India, but that's the AI sector, and I think all VCs will invest wherever the raw material is coming from. If we are getting more app companies, we'll invest in more app companies, which is, I mean, they are good, it's not bad. But generally they have a little difficult to succeed versus, because the competition is easier to build in the app layer. The second, I think, trend which I'm very excited about is deep tech and manufacturing. And more so for deep tech, because now we are seeing companies which are doing innovation in India. Which are saying, I am going to do fundamental scientific innovation and compete with the best companies globally, be it material science, be it satellites, be it space, all of those things, semiconductors and the like. And I think that sets us up very well for the next 20 years to see a lot more better innovation. Because any company can either be an innovation company or execution company or a distribution company. That's my thesis. And the strongest moat is in innovation. It is the hardest to build also. And actually capital efficiency goes like this. If you're building a distribution company, you will spend a lot more money than building an innovation company. So I think that these are the trends. The deep tech and manufacturing trends are very exciting for me. Manufacturing is harder because you already have China is the big daddy of manufacturing. So what are you bringing to the table, which India can do better than that? And we have a big problem out there of skilled labor, right? So, I'm on Zetwork, and I think Zetwork can grow much faster, but we always come back to like, India does not have enough skilled labor for us to grow faster. So that we have to own and we have to invest. Like the government has to invest, startups have to invest, private sector, public sector, everybody has to invest to grow for us to be able to succeed 20 years from now. Yeah.
Amit, where is venture money going and where is early stage company generation happening?
Yeah, I'll just pick up on the AI thing a little bit. So I think AI is going to be and is probably already becoming all pervasive at all levels, right? So Prayank gave a framework in terms of the stack, but even in terms of just using AI to make your own business more efficient or be better appreciated by customers, right? Forget being an AI company. And it's like 5 years ago or 7 years ago, you could say, are you a mobile company or a mobile app company? 15 years ago, you could say, are you going to the cloud or not? Whatever, right? So that's how it is. So many of our companies, in fact, one of our actually common companies, but won't name it, they laid off 50 people because they're like, I don't need that big an engineering team because a lot of what some of these folks were doing, I'm going to leverage AI to do it more effectively. I hired my first AI trainer for myself this last week because I was struggling to get scheduling and the quote-unquote attitude of physical trainers. So just for me, I'm not trying to do body sculpting here. So I actually paid an AI agent, and so now I'm being trained by that AI agent, right? So I think there are many examples, whether it's applications, whether it's use of AI in your area. So those are all very interesting. One other thing I will say, just in terms of areas beyond a couple that Prayank has covered already, is really I think businesses are now coming of age in India, and the adoption of technology is much more than listing your wares on a Flipkart or your restaurant being served by a Zomato or a Swiggy or what have you. So I think there'll be a lot of interesting things in B2B in India where the adoption of technology, even beyond AI, right? So whether it's in the agri space or chemicals or whatever. And so I think there are some very interesting opportunities there, also the China Plus One. So those are a couple of other areas, but I think AI is going to be all pervasive everywhere. There's no such thing going to be like an AI only company beyond, unless you're in really deep infra.
Okay. Anand.
Yeah, so if just zooming out a little bit from that, the framework that we think is essentially we try to look for the next disruption. And disruption can happen in 3 ways broadly: if there is some technological innovation, if there is some business model innovation, or if there is a regulatory or let's say overall a macro change, something. And we are seeing green shoots on all of these areas and then go bottoms up to invest on that. Technological innovation, if you talk about it, nobody can not touch AI right now, like AI is happening. There are a bunch of other technology innovation also which is happening, which is specific to India. If you look at the India's digital infrastructure that is getting created, whether it's account aggregator, whether it's, let's say, UPI, we have invested in a credit card on UPI company, we have invested in an account aggregator company. If we are looking at AI companies, you have to benchmark and you have to decide whether it's for India or whether it's for global. If you are investing in a global company, you cannot not benchmark yourself globally. And that's where the one team structure for us, having global structure helps us. There are business model innovation which will come up. Zepto is a purely business model innovation. And on that business model innovation also you can, and that goes back to the supply chain and everything you talk about. That can also create an outsized impact as long as it's working on a large dam. And then there will be regulatory impact all about manufacturing and the supply chain that we are talking about. There will be regulatory or the tailwinds around how supply chain, how consumption in India will drive supply chain creation. Like you buy more electronics, electronic supply chain will change, affected by how government is supporting. We have seen this in pharma, we have seen this in auto component where India has auto companies of its own and then the auto component supply chain is forming. We are seeing this now in specialty chemicals, we will now see that in electronics. So we have made investment in specialty chemicals, we have made investment in electronics supply chain company. So that's broadly, we will be keeping a lookout for where in these three fronts there is a particular chance of a disruption and what this disruption, can this disruption then disrupt in a way that it creates a large outcome. In that framework, we will keep seeing company come.
Okay. Kanika, so I see some semiconductor interest that you have, so you can.
Sure. So I think the, just to pick up on Prayank's point that we're seeing a resurgence of deep tech coming out of India. And I think it's a post-COVID phenomena as well because there's a lot of government support. There's a lot more boldness in the ecosystem, right? So I think here the kind of thesis we are building is that we want to back areas where India has a natural advantage. And this advantage can essentially take you global. So we are not particularly interested in India-focused technology. It has to be something which can scale globally. So the team has to be something which can beat, or compete with the best in the world. So I think we realized, recently that actually semiconductor is one ecosystem where India has a natural advantage on the design side. So the unknown fact is that a lot of semiconductor companies globally, a lot of the designers are actually Indian. Yeah. And the team we've backed is essentially a team which has worked across some of these companies and has come back to India, and they're starting with a specific design for a specific product. And then alongside that, we're seeing a lot of ecosystem support, which also ties into India's intent to become more visible globally in the sector. So I think that is an ecosystem support which we will count on, and therefore we also want to back a team which has the right network to build it. So that's specifically on this investment, but I think broadly the strategy is you back a team which has global expertise and global competence. You back a team which has the network, and then you also don't want to go too broad. So for example, in this investment, they're going to start with one chip design for one product, which has a large enough market. And if you crack that, you can go to market 2 and market 3. So it's a very nuanced strategy, but over a 10-year period, there are many such technology sectors emerging which can become more valuable.
Sure. Ritesh, so Stellaris had a big payday at Mamaearth, so, and what excites you?
It's a little hard to come right at the end when my colleagues have spoken about several of the sectors that we are excited about. I'll maybe pick one. I'm very excited about the impact that AI will have on the services industry in India. It is one of the largest sectors of the Indian economy, IT services and IT-enabled services. And our thesis is that the technology shift that allows a more efficient delivery of services will create an opportunity for new players to take on the 100 billion plus kind of players that exist in the industry. And we would like to make investments both on the IT services side as well as on the IT-enabled services side with more efficient players that leverage AI to deliver those services.
So yeah, I think we have just 1 minute, maybe just one question we can take just in case. Yeah, sure. I'll give my mic.
I would love to ask for all of you that do you think that AI will replace everything, the startups? Because people are talking about AI, and I'm also working on AI, artificial intelligence with machine learning and data privacy. I would like to know from all of you, because we are all into startups and everyone talks about AI. Does that AI replace everything?
Okay, so maybe I'll go first. So I don't think AI will replace everything. It's not possible. I mean, human creativity is super important. And I think that's what is, and ingenuity also, right? So not everything goes in straight line. So all of that is important, which AI does not have. AI is a great productivity enhancer. If we get to AGI, it's very difficult to imagine that world, but today and maybe for the next 4 or 5 years, I don't think any of that is changing. Even if AGI comes, I think it can't have borrowed creativity. And yeah.